All right, so I've neglected looking at 529 plans much in probably the last 2 to 3 years. I really need to revisit this again. I can't remember, I was reading an article or something like that, or I was talking, I can't remember what it was, but it's like, man, 529s have a value that I think I'm overlooking. So let's dive in this one. This one right here is, does financial aid or 529 plans affect financial aid? And let's dive into this. This is from Saving for College. You might remember Joe Hurley was a founder of savingforcollege.com. He had written a book I got back there. I can't remember, Saving for College, I think, or something like that. I actually interviewed Joe about 3 years ago. And he's a maple farmer right north of Rochester, New York now. So he sold Saving for College, got a nice payout, and he's a great guy. Love him. So just over 1/3 of our college savings survey respondents believe that 529 plans are not considered when a college determines financial aid. But whether this is true or not really depends on a couple of things, like who owns the plan, when withdrawals are taken, and what type of aid you're applying for. In most cases, 529 plans will have minimal effect on the amount of aid you receive and will end up helping you more than hurting you. All right, so let's go down. I'm not going to read types of aid. We're going to go down here. Account ownership. The value of a 529 plan owned by a dependent student or one of their parents is considered a parent asset on the FAFSA. So the value, whether or not owned by a dependent, Chloe, we'll just use her, has a 529 plan, which she owns, is considered a parent asset. About the first 10,000 will fall under the asset protection allowance. The exact amount depends on the older parent's age. Okay. Any parental assets beyond that amount will reduce a student's age financial package by up to 5.64% of the asset's value. Okay, that's good enough. So if your 529 account exceeds the $10,000, your financial aid could be reduced by $564. All right, gotcha. 5.64 of the value of the asset. Okay. Of course, no one wants to lose 564, but the tax-free investment gains have easily outweighed the 564 you lose in that. I completely agree. But other student-owned assets are not treated as favorably. UTMA and UGMAs, uniform gift or uniform transfer to minors, will be counted as a student asset and will reduce the financial aid by 20% of the account value. So a student's got 20,000 in an UTMA or UGMA will lose 2,000 less financial aid, versus that student had over 10,000 would lose only 564. As mentioned, 529 plans owned by a grandparent or other relatives are not included in your FAFSA. Any interest, dividends, or capital gains generated from the student's asset that are reported on the federal income tax will be counted on the FAFSA. This income will be assessed at 50% when calculating the earned family contribution. What the hell does EFC stand for? Well, I forgot. Family contribution, expected family contribution. EFC is expected family contribution. All right. So let's go down here. So earnings in a 529 plan, however, do not have to be reported on the FAFSA and will have zero effect on financial aid. So earnings are tax-free. It's just the account value that could be affected. And again, it's only 5.64%. Now, here's the issue that always confuses me. Withdrawals. 529 plan distributions are another area where the impact of financial aid will depend on the account owner. With a parent or student, Josh or Chloe, 529 plan withdrawals used to pay college will not be reported on the FAFSA. So I have 20,000 to 529. I put 5,000 in I take 5,000 out as a withdrawal. That is not considered on the FAFSA. That means if you liquidate your account to pay for your child's sophomore year, there will be no effect on subsequent FAFSAs, subsequent year's FAFSAs. But the situation gets a little stickier when the account is owned by a grandparent. The student will have nothing to report on the FAFSA while the money is sitting in the grandparent account, but withdrawals used to pay for college will be counted as untaxed income on the FAFSA. Untaxed income has the same impact as eligibility for need-based financial aid as taxable income. So they give an example here. Let's say grandma wants to cover a full year of her grandson's tuition at a private college. We'll say it costs 45,000 schmackets. He'll be a freshman in the fall, and he plans on applying for financial aid every year. On his first and second FAFSA, he'll have nothing to report. But when he applies for federal aid for third year in college, when he's required to report prior year income, his untaxed student income that was generated from grandma will reduce his financial aid package by as much as $22,500 or 50%. Because he basically has all this income, they're going to say, hey, it's good that you have all this income, but it's from 2 years previously. To prevent this from happening, grandma can wait until January 1st of the grandson's second semester of his sophomore year to pay his tuition. What I would suggest, just make it simple, I can't remember exactly how this works. It's been a long time since I really dived too deep in 529s, is for grandma to wait until year 4. Is it year 4? To pay the bills. If that, I think, yeah, because I think you can pay your student loans directly with your 529 plan. So don't pay the tuition right out of pocket. Just let the kid take the loan and pay it all off in one fell swoop in year 4 or year 5 when the kid graduates. You can also, all right, so basically, grandma can wait till January 1st of her grandson's second year of his sophomore year of college to pay his tuition after he completed his last FAFSA. This, of course, assumes he's graduating in 4 years. So what she's saying is wait until, I like this too, wait until the second semester of the sophomore year, but that won't show up because he already did one FAFSA year 1, did one FAFSA for year 2, one FAFSA for year 3, and what that is affected by is the income he received from the 529 from grandma in year 1 when he's a freshman. It's almost like a 2-year look back. One FAFSA for year 4, which will look back as sophomore year. So basically, grandma takes the money out in the second semester of the sophomore year. The fourth year FAFSA won't see that as income, which is a pretty good move. You can transfer account ownership to the student's parent, but the funds would be counted as a parent asset and reduce the following year's aid by up to 5.64%. A third year is to roll over the money from the grandparents' 529 to the parents' 529 1 year at a time. Okay, that makes sense because you're still reducing by 5.6, but it's only basically 11,000 a year that you're reducing it. All right, good stuff. Pretty good article there. More to come on 529s. I just say, look, if you got the money in 529, just pay it right out. Be direct with it. Be done. Don't take the loans to begin with. But I don't have any money in 529. So, and this is something I think is a big deal. I talked to a lot of people got 20 and 30,000 in 529s. Got to revisit this because it is tax-free, man. I mean, it's tax-free for a lot of different things. And they just, under the Trump tax bill, they changed the rules too. So a lot of 529 stuff that might be applicable to you that we've been overlooking here at Heritage Wealth Planning. And we want to revisit this time. Love to hear your thoughts. Thanks now.